Well, hello, everyone. Welcome to today's live stream, which we're calling the 2024 Year in Review. These are the most visited blog posts on our website last year, and we get 37,000 visits a year from lending and credit professionals just using an internet search to get answers they need to tax return analysis and cash flow and global cash flow questions. So, top three, we're oriented towards pass-through entities. Not a surprise, right, David?
Right.
Our favorite topic. Oh, by the way, this is David Stuffaker. He is one of our senior credit trainers. I am Linda Keith, chief credit trainer at Lenders Online Training, where we help lending professionals say yes to good loans. So, top three oriented towards pass-through. And you're going to see me reading a little bit because I want to make sure I get this right. One was passive versus non-passive income. Another was guaranteed payments, and we will add why the heck they're not guaranteed, even though it said that. And then K1 contributions and distributions. So here's what happened. We thought we could cover three. And then as we started preparing for the live stream, we realized this was going to be way too long if we actually did the three the way we want to do them, which on the live streams, it's not training, it's insights. And some of you are new to this, but some of you are the more experienced people, the people that set guidelines, the people that do the on-the-job training. So we're trying to do a little deeper dive for you so that you have that context, which means it takes a little time. So we are going to dive into the passive versus non-passive. We will touch on the other two, and then we will put up a live stream just on guaranteed payments and the K1 contributions and distributions. So we're starting with passive versus non-passive, the where, the what, and the why do we care. David, where does this even show up?
Well, thank you. When we see these words passive and non-passive in the 1040 Schedule E, it's actually on part 2 of it. The Schedule E actually has 3 portions to it. Now, this is where we see the pass-through income, losses, credits for those that are involved in partnerships, multi-owner LLCs, as well as S corporations. That's on their personal return. Now, it's common that we get the 1040 tax return when we're lending personally to an owner of an entity or an investor. And sometimes, probably most of the times, if we're dealing with dealing with the entity directly, and we're going to have a guarantor, we're going to ask for the 1040 as well, because we're going to do a global overarching analysis of the cash flow. So in essence, for many of you right now, if you're, the process of doing the analysis, passive versus non-passive, you're probably not going to really care at this moment of, because you have guidelines. Your bank, your institution has guidelines. And for example, you might think that if it's, you have an owner that's less than 25% ownership in the affiliation, you're probably going to be fine with a K1. If it's greater than 25%, most likely you're going to ask for the full return to do a global analysis. But in essence, whether it's passive or non-passive, you've got guidelines and you're going to probably move beyond those definitions.
At which point, I know some of you are thinking, okay, well, I do have guidelines, so I can ignore the rest of this live stream and go do something else. Passive versus non-passive, not so important. Excuse me. Don't go anywhere. And here's why. In our opinion, it does make a difference. It makes a difference in how you understand your borrower. It makes a difference if you've got 27 K1s. Are there any that we can skip? And are there others that are absolutely critical? So we want to convince you that understanding this is critical, even if your guidelines are totally focused on percentage ownership. So, David, once again, the IRS has chosen some terms that we kind of roll our eyes about, and that's certainly this one, passive versus non-passive. So help us with sort of a actual understandable definition of that passive versus non-passive.
All right, let's first begin with non-passive income. This represents the share of the owner's taxable income, losses, credits, when the owner is actively involved in the organization. Now, the entity itself, it may be a business, could be an investment in real estate. And on the 1040 or the Schedule E, the description line is pretty tight anyways. And if we don't, maybe the name implies what entity it is, but the focus is that it's non-passive is the focus basically. And that's the choice of words that we chuckle about. Oftentimes, and for example, in this one, we're dealing with a double negative, non-passive. It was confusing to me earlier on when I was chatting with Linda times ago. So in our training, what we do at Lenders Online Training, we like to, we suggest using the word active for non-passive. I mean, we think it's more clear. The owner is active and actively involved in the organization. They're making the decision, so why not use the word active? So passive income, okay, basically means income that's earned from the taxpayer who is not active. Okay, maybe it's not materially participating. They're not doing that much. They're basically in it for investment. In essence, we basically recommend, we invite our bankers to use the word investment for that. They're not involved in the day-to-day operations. They're not involved in the decision making. It makes it more clear, right, Linda?
Yeah, I really think of investor or active. Investor or active. Now, when I have all these K1s, here's why I think this becomes so important. People who are actively involved are more likely to be higher percentage owners, are more likely to have guaranteed debt, and are more likely to have control over what they personally get paid. Now, I do know that sometimes lenders will say, well, but Linda, that entity is not obligated on the loan. So we got a couple different possibilities. One, it's non-passive, which is active. It is the entity we're lending to. Well, we're getting their whole return anyway, so that's not an issue. But if it is not the entity we are lending to, it's another entity owned by the owner, then the next question is, are they going to guarantee the loan? And probably not. They're not going to want to. So I do have sometimes bankers who say, Linda, they're not obligated on the loan, so we don't have to go get it. I would suggest that if I were an owner and I own two different entities, one's doing really well and the other one is in the toilet and almost beyond help, which one am I going to come borrow with? I'm going to come in with the one that's doing well and maybe hope you don't even notice this other problem. And then as a high percentage owner, if that's the case, I get the loan on the one that's doing well. And what do you think I could do? Depending on your loan covenants, of course, debt coverage and liquidity and whatever else, I really could rob Peter to pay Paul. And I just might. So we believe that when it is businesses that they're actively involved in, whether you're lending to those or not, you might want to do the work to understand whether those other entities are a problem or not. Now, passive side, more like investments, often low percentage owners. Those guys are not guaranteeing debt if they can possibly get away with. We can't know for sure, but generally not. And you can at least see the income or loss figure, although those are taxable numbers, not cash flow. Not cash flow. Now, one more piece of the puzzle, and this one, guys, is an advanced idea. So if you are at the basic level and this one doesn't make sense, just let it go and say, well, that was interesting. But if you are up in the group that does set guidelines or do major management, this one I think is important for somebody to know clearly. Passive losses can be limited. Passive losses are limited to earned or non-passive or investment income. Whenever you have a limited loss, you have the potential for carryovers, and carryovers are non-cash. Let me give an example you may be more familiar with. Capital gains, if they have a loss from capital activities in a 1040, they're limited to $3,000. So we have a big loss. We get to take $3,000, and what do we do with the rest? Carry it over, try again next year. Can't take it that year, carry it over, try again next year. By the time we finally can take the carryover, it's not cash in that year. It was cash 3 years ago or 7 years ago. And we do know, or many know, that on the capital gains page, if it's on the carryover line, we don't count it. We understand that it's not new cash out this year. That's true of net operating losses as well, non-cash carryovers. We train our bankers to ignore that number, although I have some advanced ideas about that too. But with regards to the carryovers that are triggered because of these passive loss limits, those could be kind of anywhere. I could have a rental that moves into positive income category because depreciation's finally used up enough. And all of a sudden, I get to bring in some carryovers that were disallowed before on that particular rental. They're going to be buried in the middle of the expenses. If your folks don't know to look for carryovers and leave them out of expenses, you could make a mistake, and it could be a big mistake. So the practical matter is, don't use the numbers on the back of Schedule 1040 Schedule E because they are passed through anyway. Understand that passive is more like investment, non-passive is more like active. If I had a lot of K1s and I was at all inclined to skip any of them, I might skip some on the passive side. Remember the word might. I would probably myself never skip something on the non-passive side because of the possibility of the owner guaranteeing debt or the owner trying to come to the table and solve a big problem. Now you see why we did live stream on all three topics, because we just spent some time on this one. But let's go ahead and at least touch base on the other two since we kind of promised.
Let me talk a little bit about a high level on just the guaranteed payments. That was another topic that most people had selected last year. Guaranteed payments. And actually, our producer is going to be putting a link on there if you don't have the time to wait for our upcoming live stream. We are going to be doing a live stream on this topic. Then we're going to be a little more devoted to it. Give it some more time. You can look at the link there. So let's talk a little bit about guaranteed payments. Basically, they're only found in the 1065 for the entities that are filing that. The amounts basically represent monies paid to the owner regardless of ownership percentage. Now, distributions, slightly different. That does reflect the percentage of the ownership. So also, I've always viewed these as kind of salary, kind of wages, compensation. They could be return on investment, but oftentimes I don't know where they're looking at. The other thing to be concerned is with regards to is the guaranteed focus on them. We're going to touch about that further in the future live stream because I want to talk about where you may find these guaranteed payments, if it is actually cash flow or not. And if it's included in other figures in the tax return, the adjusted gross income. And we're going to talk a little bit about the word of guarantee because it actually is misleading. So if you cannot wait for that live stream, we've got in the link there. It's lindakeithcpa.com. Basically why guaranteed payments are not guaranteed. So I think you might find that interesting as well. Linda, we got one more thing. How about K1s?
Yeah, the K1 contributions and distributions. So a little bit of a high level on this, and you'll see on the screen, our producers put up, if you go to lendersonlinetraining.com, just go to the search bar at the top and click on, type in K1. You're going to get several blog posts on that as well. So K1 contributions and distributions. Here's 5 tips for right now, and then we're going to invite you to the live stream for that one as well. First, 1065 K1 is different than the 1120 SK1. The distributions, contributions are in different places. They give you different information. So when you can't find something on a K1, maybe you're thinking of the other one. The second is both contributions and distributions could be cash or property. And many lenders treat property distributions different than cash, although I would suggest maybe that doesn't make sense all the time. Neither contributions or distributions show up as income or expense in the entity. They're considered capital entries. So when distributions are a little bit more like compensation of officers, like in an S Corp, where they choose to take some of their compensation as wages, but some as distributions, if those distributions are really more like compensation, I at least mentally move them to the operating side so that I have a better picture of operating margin or operating deficit. And then there's a real tricky area. If you're lending to an entity, you're doing a global analysis, but not every owner is guaranteed or guaranteeing, then how you don't double count or miss some of those distributions made to the non-guaranteeing owners, that's a bit tricky too, which is why you can see we've decided to do a whole live stream on this item. All right, so let's see. That is it for today. I've asked our producer to put a URL at the bottom of your screen. lendersonlinetraining.com, ask the experts. This is where you would seek out a different kind of way of getting information when we put those Ask the Experts blog posts up. So these are real questions from real lending and credit professionals. We put up one a week. The subject line always says what we're talking about, what question we're answering. So if you would like to go sign up for that, Ask the Experts, on the URL that she just put up a moment ago. There it came back. That's the place to get on that email, and easy to come off as well. But I would suggest to you that's the drip method of learning or learning more about tax return analysis. And then last, experts at lendersonlinetraining.com. If you have a live stream you want to recommend, or if you have a question that you want to ask, that's the place to ask it. We always answer, and sometimes we do a live stream on it. Thank you, David.
You're welcome.
Thank you, everybody.